How should you choose your equity mutual fund? What are the effective ways to choose an equity fund? To enlighten you more on this, we have our investment expert Mr. Hariharan with us. Hariharan, over to you.
So let's understand what are the various risk adjusted parameters. We have got something called standard deviation. We got beta, we got Sharpe ratio, we have got Jensens alpha, and we have got capture ratio. So we will understand each one of them quickly. This is again a technical topic. I will try to make it as simple as possible. And this is again some of the risk adjusted parameters that investors should look at before you select a fund. So let's start with the first one, which is standard deviation. As the name suggests, it is nothing but what is the spread of returns. Now, what that spread means is that, so one is standard deviation measures what is the total risk in the fund. What is the total risk in the fund? It measures the volatility of the fund. So I'm sure, let me give a very simple example. Many of us would have, when we were young, played on that swing, Jula swing. The swing that you and I perhaps played were the small ones, right? Which would go from, say, this part to this part. So if you were sitting in that swing, you were enjoying that swing, the risk was very limited in the sense that even if you fall from the swing, you might just get some bruises or in the worst case, some fractures, right? Compare that with the swings that you today go into some of those play games, play zones. I don't know what is called those places where you have those huge swings. If you sit in those swings, you are taking a higher risk. The excitement could be higher. The growth potential could be higher, but the risk is very high. So if you compare that swing can go from so high to so high. So the spread of that string coverage is so much, okay, compared to the smaller swing, which will only cover this percent this much. So therefore, when you look at it, when we talk of standard deviation, it is the volatility or the spread of returns. Longer the spread, higher is my volatility, higher is the fluctuation. Smaller the spread, smaller is the volatility, smaller is the fluctuations, lesser is the risk. So from an investment perspective, let us look at this. You look at a fund and you say that the fund has delivered 12% return in the last 3 years. And this fund has a standard deviation of 6%. Now, where is this data available? This data is available in the fact sheets. So 12% return, 6% standard deviation. So what it means, how you interpret this data is, you do 12 plus 6. So the swing goes on the positive side plus 6, negative side minus 6. So 12 plus 6, 18, 12 minus 6, 6%. So what it tells us is that, generally speaking, the fund's performance ranges between 6% to 18%. Now this 6% has no value unless you compare it with somebody else. So if I have another fund which is 12% returns, but 10% deviation, what it means, 12 plus 10, 22 on the right hand side, 12 minus 2, 2 on the left hand side. So this fund will deviate from 2 to 22. The one that you're seeing on the screen will deviate from 6 to 18, which means this fund is more stable as compared to the other fund. This fund is less fluctuating, less volatile as compared to the other. And that is what standard deviation captures. It's a measure of the risk in the fund. What is the extent of volatility in the fund? And therefore, when you select funds, remember the concept that higher the standard deviation, higher is the fluctuation, higher is the volatility, higher is the risk. And therefore, when you want to select funds, first important point, compare within the same category. So if you're looking at a large cap fund to select from, you'll have to look at all large cap funds and their standard deviation. If you compare the large cap fund deviation with the small cap fund standard deviation, small cap is assumed to have higher standard deviation. That's incorrect. You have to compare apples with apples. And once you have compared, select the fund which is the lowest in terms of standard deviation, because you don't want fluctuation. You don't want too much of volatility. So standard deviation helps us to find out what is the extent of fluctuation, volatility in the fund, and therefore you choose it, select within the category, and choose the fund which has the lower standard deviation. Let's go to the second one, which is beta. Now, beta is essentially talking of what kind of returns can I expect from a fund relative to market. Please remember the word is relative to market. So market is supposed to have a beta of 1. I could have a fund A which is having a beta of 1.2. I could have another fund which has a beta of 0.8. Now let's understand how this works. So beta is relative to market performance. How much can my fund perform or deliver? So if I have fund A and B, and if the market has delivered 10% positive returns, fund A, which has a beta of 1.2, will deliver 10 into 1.2, which is 12% returns. So higher the beta relative to market, more is the performance. On the other hand, fund B, which has a beta of 0.8, will deliver 8%, 10 into 0.8, 8%. So what beta tells us is relative to market, what could be my performance from the fund. So from a cricket example, let me quickly give a cricket example here. Suppose there's a one-day international match. The team batting first has scored 299 runs in 50 overs. So the team batting second has to score 300 runs in 50 overs. So run rate required is 6 runs per over. There are two set of batsmen available. Batsman number 1 can score 120 runs in 100 balls. So he has a strike rate of 120. I have another batsman 2 who faces 100 balls, scores 80 runs. So his strike rate is 80. Right? So that's the example you are looking at. Imagine if batsman 1 were to play the 50 overs, who is striking at 120 per 100 balls. Target is 100 runs in 100 balls. So if he were to bat the entire 50 overs, you will not even need 50 overs because he's striking more than what is required. So he's scoring faster than what is required. On the other hand, if I allow batsman B to play the 50 overs, he will score 80 runs in 100 balls. He will consume 50 overs and score only 240 runs, and I will lose the match. So one batsman is playing faster than what is required. One batsman is playing slower than what is required, and that's beta. One fund is scoring faster than the market. One fund is scoring slower than the market. Getting the point? So now a quick question to you. Which fund should you select? Fund A or B? We have only looked at positive market. And therefore we said we want A. Markets can also fall. Markets can correct. So if market falls by 10%, what will happen to fund B? Fund A, it will fall by 12%. Fund B will fall only by 8%. Very important point. Therefore, when you select funds based on beta, you will have to select funds basis what is your risk appetite. So if you are an aggressive investor, you will select funds which are having beta more than 1 and reasonably higher values, 1.3, 1.4, 1.6 kind of funds. On the other hand, if you are a conservative investor, as per this profiling, you should select funds which have lower beta. When I say lower beta, less than 1, 0.7, 0.6, 0.8. Medium, moderate investors should select funds which have beta very close to 1, 0.9, 1.1, those kind of funds. Is it clear? So when you now select funds, basis your risk appetite, you will have to select the funds based on their beta. Right? So we've done standard deviation, beta. Let's quickly go to the next one, which is Sharpe ratio. Now again, let me take a quick cricket example here before we come to this. Now in a cricket match, you see that there are 11 players who play the match, right? Now when you create the composition of the team of 11 players, the captain and the coach take some calculated risk. Now what is the calculated risk? Depending on which pitch they are playing, where they are playing, they either include one extra batsman or they include an extra bowler, isn't it? So if it is played on a flat pitch, like India one-day match, where 400 runs can be scored, they would want to go with a higher batsman so that even if the team plays and scores 400, they can chase it. On the other hand, when it's a low-scoring match, which is slightly difficult pitch, again, they may want to add an additional bowler, additional batsman. Now that depends. Okay. Essentially, what I'm trying to say is the coach and the captain take a calculated bet of either increasing the batsman or increasing the bowler. Now, when will we know that this decision of they playing an extra batsman or an extra bowler is justified? It's only after the match is over, isn't it? So if I have played an extra batsman and that batsman were to score good runs and win the match for the team, I would say that, boss, I have done a great job. I selected him. On the other hand, if I have played an extra batsman and that batsman gets out in the first ball, my decision is gone, right? Similarly, bowler. I have taken an extra bowler. That bowler bowls very well, picks up 3 wickets, does not give too many runs. I will say that my selection was wonderful. On the other hand, I have taken an extra bowler and he's taken for runs. He's given 80 runs, 90 runs in 10 overs, not taken any wickets also. My decision of selecting extra bowler has backfired. You look at a particular number and you say that wonderful job. But to get that wonderful job, you have taken a risk. Am I getting rewarded for that risk? And that is what Sharpe ratio tells us. So Sharpe ratio tells us that if I have 1 lakh rupee to invest, I can go to a State Bank of India bank branch, do a fixed deposit with SBI for 3 years or 5 years, and let's hypothetically assume SBI gives me 7% returns. Is the 7% return guaranteed? Yes. Is it safe? Yes. On the other hand, I meet you on the road and I say, why are you doing that FD? You give it to me in mutual funds. I will invest this 1 lakh in a mutual fund. And you agree to do that. So when you agree to do that, you have now taken a risk of giving that 1 lakh to a mutual fund, and the fund manager is going to deploy this money in stock market. Is going to take that risk. When is your decision of investing in the mutual fund justified? If you get returns better than fixed deposit, isn't it? If I also deliver that same 7% what FD has delivered, you have taken the risk, but you have not got rewarded. And that is where Sharpe ratio comes into picture. For the risk that you take as an investor and as the fund manager takes the risk in his portfolio, is he delivering you the reward? And there's a formula that I've given here. Is the return of the fund minus the risk-free return divided by the risk that he has taken, which is measured by standard deviation. So again, don't get into the data perspective. Just analyze the data. Same category, you'll have to compare the funds. Select the fund which has a higher Sharpe ratio. I don't mind taking a higher risk as long as I'm getting rewarded for that risk. Important. Okay. So analyze within the same mutual fund category. If it's mid cap, compare only mid cap funds. Select the fund which has delivered a higher Sharpe ratio. There's another variation of Sharpe ratio which is called as a Sortino ratio. So Sortino is very similar in terms of the formula. The only difference is in the Sharpe ratio, the denominator is standard deviation, and standard deviation can be positive, negative. We have learned that. Sortino takes only downside standard deviation. So wherever the fluctuations is on the negative side, only those data is taken and that formula is applied. So therefore, what Sortino tells us is that how is the fund capable of protecting the losses? Because only taking the downside values. So is the fund capable of protecting the losses? And therefore, again, higher the Sortino ratio, better it is, which means that in the case of downward market, this fund is better off in protecting the investment. Okay, so again, Sharpe or Sortino, choose the higher one. Sortino is not readily available. Okay, Sharpe ratio is reasonably easily available. So generally people tend to go with Sharpe, but Sortino, according to me, is a slightly better indicator of the reward, especially in a downward cycle, downward market. Risk-free rate is not FD typically, as per the SEBI guidelines, it is typically a 1-year treasury bill, which is a security issued by the government of India, is what is generally considered as a risk-free rate for calculating the Sharpe ratio. The next one is what most of us would be aware of, and that's called alpha. And this is what all of us want in our investment, right? We want alpha in investment. Now, what is alpha? What we generally know as alpha is what is the extra returns that my fund has delivered as compared to the benchmark. Okay, this is what most people know alpha as, but I'm going to talk and introduce you to something which is very interesting, which is called Jensens Alpha. Now, to explain that, let's look at the table there, which is there, which will explain it. So let's assume I got two large cap funds, A and B, and both have the same benchmark, which is Nifty 50. And the Nifty 50 has delivered 10% returns. Now, actual returns that is delivered by fund A is 12%. Actual return delivered by fund B is 14%. So what alpha we normally look at is extra returns over the benchmark. So benchmark is 10. Fund A has delivered 12. So my alpha is 2%. Fund B has delivered 4% alpha. So what I would do, I would go and choose fund B because it has delivered 4% alpha, right? I'm going to share something very interesting, which is Jensens Alpha. Now, what Jensens Alpha says that every fund takes a risk. And for the risk that it takes, there is an expected return from the fund. Compared to that expected return, what has been the actual return? And then you subtract that and figure out what is Jensens Alpha. So now you look at A. Let's say fund A has an expected return of 11%. Fund B has an expected return of 15%. Why it has got a higher expected return? Because that fund manager has taken higher risk. Therefore, the expected return, there's a formula to calculate that. I'm not getting into that formula. So that fund is supposed to deliver 15%. Fund A is supposed to deliver 11%. What A has actually delivered is 12. What B has delivered is actually 14. So now you see, the moment you apply the concept of Jensens Alpha, the expected return, your decision will change. Because now when you compare actual versus expected, fund A has still given you 1% alpha, whereas fund B has given you -1. Because it was supposed to deliver 15, it has delivered 14. Again, going back to that point, you and I, when we invest in an equity fund, we assume a risk. that fund managers taking risk, are we getting rewarded for the risk? So all these parameters, especially Sharpe and Jensen Alpha, is going to tell us, are we getting rewarded for the risk that we take? Because when we don't look at this, we just look at 25% CAGR, we feel happy about it. We got 30% return, fantastic. But possibly that fund which is delivered 30 was supposed to deliver 35, possible. And that is why all these becomes critical in analyzing and selecting a fund. Let's quickly come to the last one, which is the capture ratio. Again, not many people use it, but it's an interesting one. Capture ratio is essentially what it says is that when the market goes up, how good has been my fund in trying to capture the upside in the market. And similarly, we have a down market capture where when the market comes down, how good is the fund in terms of protecting my downside? So it's an ideal world. What is the ideal world? That you take an elevator or an escalator to go up. So when the market is going up, you want your fund to deliver more than the market. But when the market is coming down, you want to come by staircase. You want to come slow, which means when the market is correcting and falling, we want our fund to not fall as much as the market. So it's an utopian world. But there are these ratios which tell us how is the fund performing in a up market, down market. So the up market capture ratio, the more the up market capture ratio, the better it is. So if market has delivered 10%, my fund has delivered 12%. So the ratio is 12 divided by 10 into 100. So 120% is my market capture ratio. Very good. On the downside, I want it to protect, right? So lower the better. All right. So this is the capture ratio. Again, not many people are aware of this. Not many people look into this, but this is again a good indicator to look at when you want to select funds, especially as an investor. If you're also worried that what will happen to the fund when the market corrects or falls. So it is good to look at the down market capture ratio also. All right. So these are the 5 risk-adjusted returns that we have discussed.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.